Your bank has a business model, and that business model depends on you not knowing 5 things. Today, I'm going to tell you all 5, and then show you exactly how to use each one against the bank, instead of letting the bank use it against you. This is not a video about being angry at your bank. This is a video about being smarter than it. Here's where we start. Right now, the 3 biggest banks in America are paying their savers 1/100th of 1%, 0.01. Meanwhile, they're charging you over 20% on the credit card in your pocket. That gap, that spread, is the most profitable trade in the history of money. And every single day, you are standing on the wrong side of it. Let's flip you to the right side. First, drop the conspiracy. Banks are not evil. They're optimized for themselves. Every product they've sold you, every rate they've quoted you, every account they've recommended, it was engineered for their margin, not yours. Once you can see that architecture, you can build around it. In the last episode of Fortress Wealth, I showed you how the 1% hide their money. Today is the other half of the story, how the system quietly extracts it from everyone else, and the 5 exact counter moves that stop it. 5 moves they make. 5 flips you make back, and move 5. It takes 12 minutes on the phone and works about 70% of the time, so I'm saving it for last. Let's go. Flip number 1, the float trap. Here's what they do. You park your cash in a checking or savings account, and the bank pays you almost nothing. The national average savings rate right now is around 1/3 of 1%, and at the biggest banks, it rounds to 0. Then they take your money and put it to work. They lend it out. They buy treasuries. They park it overnight at the Federal Reserve, where the rate sits between 3.5% and 3.75%. They are earning multiples on your dollar and handing you the crumbs. You are not the customer here. You are the raw material. Now the flip. That same money in a high-yield savings account at an online bank earns around 4% today. Fully FDIC insured, same protection, same instant access. Treasury bills bought directly at treasurydirect.gov pay similar rates, backed by the US government. Money market funds at Fidelity or Schwab do the same. Watch what that does. $50,000 in a typical big bank savings account earns you about $200 a year. The same $50,000 in a high-yield account earns roughly $2,200. That's $2,000 a year for one application and 0 added risk. Over 10 years, that gap compounds past $27,000. This isn't a banking fee. It's a tax on not knowing. And unlike a real tax, this one is optional. Open the right account this week. Done. Flip number 2, the credit score cage. Your FICO score is not a report card. It's a pricing tool. Theirs. It's called risk-based pricing, and it sets the interest rate you pay on every loan you'll ever take. Mortgage, auto, personal, business. On a 30-year, $400,000 mortgage, the gap between a 620 score and an 800 score can be 2.5 to 3 full percentage points. Run that out over the life of the loan, and it's more than $200,000 in extra interest. They didn't charge you more because you're riskier. They charged you more because the model said they could. The flip. Stop treating your score like a mystery and start engineering it like an asset. 3 levers. 1. Keep your credit utilization under 10%, not 30. 10. It has the highest per-point impact there is. 2. Get added as an authorized user on a family member's oldest, lowest balance card. Their history lands on your file almost overnight. 3. Pay your balance down before the statement closing date, not the due date, because the statement balance is the number they report to the bureaus. These aren't tricks. They're the same mechanics banks train their own loan officers to read. They built the game. You're just going to play it better than they expected. Flip number 3, the debt architecture. And for this one, I want you to actually go get your mortgage statement. Pause if you need to. I'll wait. Because here's what's printed on it, that they count on you never reading. Amortization is front-loaded with interest on purpose. On a 30-year mortgage, your first payment can be 85% interest and 15% principal. 5 years in, after 60 payments, you can still owe 93% of what you borrowed. They've collected 5 years of interest and barely touched your balance. That's not an accident. That's the math, working exactly as designed. Find the principal column on that statement. On a $2,000 payment, maybe $150 went to principal. That $150 is what you actually bought this month. The rest went to them. Here's the flip. Attack that principal column on purpose. Any extra payment you label principal only skips the interest entirely and shrinks the balance they charge you on next month. One extra principal-only payment a year can cut 5 to 7 years off a 30-year mortgage. Switch to bi-weekly payments, 26 half payments instead of 12 full ones, and you make one extra payment a year without even feeling it. No refinance, no permission. It works on the loan you already have. Tonight. Flip number 4, the fee architecture. This is the one that's going to make some of you angry. Good. Picture a 1% advisory fee. Sounds like nothing, right? In year 1, it basically is. But fees compound exactly like returns, just pointed in the wrong direction. 1% a year on a $500,000 portfolio is $5,000 every single year, no matter how your investments perform. Run that across 30 years at a normal 7% return, and that 1% drag costs you over $400,000 in money you never got to compound. They called it a fee. It was $400,000 of your future. The flip is 3 clean cuts. 1. Overdraft fees. Move to an online bank that structurally doesn't charge them. 2. Interchange. Every swipe pays the network up to 2.5%. A flat 2% cashback card hands that value back to you instead. 3. The big one, replace percentage of assets fees with a fee-only fiduciary. napfe.org is the directory of advisors who charge a flat fee instead of skimming a percentage of everything you own. And a basic total market index fund charges around 0.04% versus a full 1%. That difference, over a lifetime, is a house. Decide who gets to keep it. Flip number 5, the one I promised you. Banks spend hundreds of dollars to win a brand new customer. They'll spend almost nothing to keep you, because they're betting you'll never ask. So the best rates, the waived fees, the bonuses, those go to the stranger walking in the door, while your loyalty quietly subsidizes them. The longer you've stayed without negotiating, the more you've overpaid. Your loyalty isn't being rewarded, it's being billed. Here's the flip, and it's the most powerful 12 minutes in this entire video. Call your credit card company. Tell them, word for word, I've been a customer for X years. I've seen competitive offers from other cards. I'd like to lower my APR to keep my business. That's it. According to consumer finance data, that call succeeds in reducing the rate roughly 70% of the time. Drop a $10,000 balance from 24% to 17%, and you just saved $700 a year in 12 minutes. That's an effective rate of $3,500 an hour. The only reason most people never make that call is that nobody told them it works. Now you know. Five moves they make, 5 flips you make back. Screenshot that table. It's your playbook. You walked in trusting your bank. You're walking out running the math they hoped you'd never run. Next episode of Fortress Wealth, we leave the bank branch and walk straight onto Wall Street, the tax cliff that never fell, and the 7 moves Wall Street made instead. The fortress isn't finished. We're just getting to the good part.